Have you ever wondered why a company would sell off little pieces of itself to total strangers? I mean, it sounds kind of weird, right? But believe it or not, that one idea is what our entire modern economy is built on. So in this explainer, we're going to break down exactly why companies sell shares and how it created the whole stock market as we know it. Just think about the absolute giants. Apple, Amazon, Tesla. Where did all the money for their insane growth come from? It wasn't just from selling iPhones or books. Nope. They raised billions, and I mean billions of dollars from regular people, from people like you and me. And they did it by selling shares. But seriously, why would a company do that? Why would you sell off pieces of something you poured your blood, sweat, and tears into building? It seems like you'd be giving up control, right? Well, there's a really powerful reason behind it, and we're going to dig into why giving up a little bit of ownership can actually be the secret to unlocking unbelievable growth. Okay, so to really get this, we've got to start with the one huge problem that every single growing company runs into. And that problem is they always need more cash. Every company that's doing well eventually hits this wall. They've got a great product, people love them, but to get to that next level, to really become a giant, they need a massive injection of money. And what do they need all that money for? Well, think about it. They need it to build brand new factories, to fund the crazy expensive research for the next must-have gadget, to hire thousands of smart people, or to expand their business into other countries. All of that stuff, it costs an absolute fortune. So a company in that spot has a few choices, right? One, they could go to a bank and get a loan, but then you have debt and interest payments. Two, they could just use the profits they're already making, but that's super slow if you have big ambitions. And then there's door number three. Get the money from investors. And this is where things get really interesting. All right, so to get that money from investors, companies have this amazing tool they can use. They sell something called a share. But what is a share, really? Let's break it down. Okay, a share is basically exactly what it sounds like. It's one tiny piece of ownership in a company. Imagine a business deciding to just chop itself up into thousands or even millions of little equal-sized pieces. Each one of those is a share. Yeah, the best way to picture this is with pizza. I mean, who doesn't love pizza, right? The whole company is the giant pizza. And one share, that's just one slice. You might not own the entire pizza shop, but that one slice, that's all yours. And the second you buy that slice of pizza, you get a cool new name. You're a shareholder. It means you are officially a part owner of that company. Yeah, it might be a super small part, but you're an owner nonetheless. So how does this actually happen? How does a company go from being owned by just a few people to being owned by potentially millions of shareholders all over the world? Well, it happens through this massive, game-changing event in a company's life. This big event is called an initial public offering. You've probably heard the acronym IPO. An IPO is that one special moment when a private company decides to go public. It's their big debut on the stock market, selling their shares to anyone who wants to buy them for the very first time. You can think of an IPO as the ultimate fundraising event. It lets a company tap into this gigantic pool of money from the public. We're not just talking about a few rich investors anymore. We're talking about everyone. And this is how they can raise absolutely mind-boggling amounts of cash practically overnight. And the amount of money we're talking about here is just staggering. Seriously, forget a few $1,000,000. When companies like Tesla or Apple had their IPOs, they raised billions of dollars. And that is the money that fuels everything we talked about before, the new factories, the cutting-edge tech, the expansion across the globe. Okay, so that covers the company's side of the deal, right? They need cash to grow bigger and faster. But that's only half the equation. We need to flip the coin and ask, why would anyone buy these shares? What's in it for the investor? I mean, think about it from your perspective. Why would you hand over your hard-earned money for what's basically a tiny certificate saying you own a sliver of some company? What's the real motivation here? Well, it all comes down to one simple idea: a bet on the future. People buy shares because they believe that company is going to do great things. They think it's going to grow, become more successful, and that their little piece of the pie will become way more valuable down the road. And there are really two main ways that bet can pay off for an investor. First, the most obvious one: the share price goes up. If the company does well, its shares become more popular. More people want to buy them, and that pushes the price higher. So you can sell your share for a profit. The second way is something called a dividend. So what on earth is a dividend? Think of it as a little thank you bonus from the company.
When a company makes a good profit, sometimes they'll decide to share a slice of that profit with their owners, the shareholders. It's like getting a direct cut of the company's success. Okay, let's zoom out for a second and put all of this together. You've got companies on one side that are desperate for cash to fund their big dreams. And on the other side, you've got investors who are looking for a good place to put their money to work. When you bring those two sides together, something amazing happens.
What you get is the stock market. At its very heart, it's just a giant marketplace built on this simple two-way street. Companies need the fuel, the capital, to build their vision, and investors provide that fuel, hoping to get a return on their investment. And really, that's the whole shebang. That simple, powerful trade-off is the engine that makes the entire global stock market go round. It's what connects the most innovative companies on the planet with the savings of millions and millions of ordinary people, creating this incredible cycle of growth and opportunity for everyone. So there you have it. We've figured out the why. Companies sell shares to get money for growth, and investors buy them to hopefully make a profit. But, this answer just leads to an even bigger question, doesn't it? With thousands of companies out there all selling shares, how on earth does an investor figure out which ones are the winners and which ones are the duds? Now that is a whole other puzzle, and one we'll tackle next time.